Well, there's probably two lenses you want to think about: the next 3 to 6 months, which is very, very difficult to understand and articulate, and the next 3 to 5 years. I think in 3 to 5 years' time, where most of this has been through the eye of the storm, and there's a vaccine in place and businesses get back up and running, we'll look back on it as potentially opportunities on the investment front that there are there that we could have and will take advantage of. In terms of the next 3 to 6 months, it is quite balanced, and a lot of the work that our investment managers are doing are trying to engage with our clients and give them some insights as to what they expect. I think it's fairly reasonable expectation that the volatility will continue. There's a case there where things may improve. Perhaps April, March is the bottom of the economic activity. Restrictions are being eased, and there's optimism about revenue recovering. However, on the other side of that, there's concerns: are we easing too quickly, too early, particularly in the US? Will the economic recovery bounce back as quickly as what the market believes it will? And so we are somewhat in a precarious position in terms of the next 3 to 6 months, and very difficult to predict one way or the other. But looking through the lens of the 3 to 5 years, I have a lot more confidence in our strategy and the ability to continue to manage money for our clients in the long term.
Sure, and we wish you the very best for that. Emilio, I do want to ask you, however, there's much talk about how the Fed might come under pressure to go into negative territory on rates, short term as well as long duration. Right now, it seems like with the 2-year, 5-year in the US, there is that risk of getting into negative territory. What would negative rates mean for the credit markets and thereby mean for bond portfolios at large? I mean, what is the risk coming out and the implications of rates going negative in the US?
Well, I think the bigger question there is the factors driving that. And if we have a situation where rates in the US turn negative, it's because the growth, the support, the rebound is not coming through. And so there is a risk, as I said earlier, that if we don't see a rebound, if the expectations that the equity market to some degree is factoring in, then those negative rates potential coming through is coming for all the wrong reasons that we don't want to see. And then for markets, they would have to readjust their current thinking that perhaps a recovery that has factored in with the bounce in April may not be as strong as what is expected. And that's not necessarily, that won't be a great outcome for investors.